Introducing debt fund as classified by SEBI. A debt fund is a type of low to medium risk asset class that majorly invests in securities having fixed maturity dates and interest rates such as bonds, G-Sec, treasury bills and money market instruments. SEBI has categorized debt funds in 16 categories based on duration and other factors. Macaulay Duration measures the time taken by the fund to recoup the investment. Macaulay Duration of a fund measures the sensitivity of the bond or NAV to change in interest rates. The first four categories of debt mutual funds are overnight funds, investing in securities with one-day maturity, liquid funds, investing in securities with 91 days maturity, ultra-short duration funds, investing in securities that have MD between 3 to 6 months, and low duration funds, investing in securities with 6 to 12 months MD. The next 5 categories include money market funds, investing in securities with maturity up to 1 year, short duration funds, investing in securities that have MD between 1 to 3 years, medium duration funds, investing in securities that have MD between 3 to 4 years, medium to long duration funds, investing in securities that have MD between 4 to 7 years, and long duration funds, investing in debt securities with MD greater than 7 years. Next is the dynamic bond fund that invests in debt securities across different durations. Then there is corporate bond fund, which invests minimum 80% of assets in highest rated instruments. Credit risk fund invests a minimum of 65% of the assets in below the highest rated instruments. Further, banking and PSU funds invest a minimum of 80% in debt instruments of banks, public sector undertakings, and public financial institutions. The last 3 categories are gilt funds, investing minimum 80% assets in government securities across different maturities. Gilt funds with 10-year constant duration, which invest minimum 80% of the assets in government securities that have MD of 10 years, and floater funds investing minimum 65% assets in floating rate instruments. You should consider debt mutual funds if you prefer low to medium risk instruments, depending on the maturity and credit profile of the fund. Having low volatility, debt funds offer modest returns, are highly liquid, and easy to exit. Before investing in debt funds, you should consider your investment objectives and risk appetite, along with the fund's maturity duration and credit rating. Also, consider the credit and interest rate risk associated with debt funds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.